Welcome to The Deep Dive, your shortcut to understanding the most important insights from recent earnings calls.
Great to be diving in again.
Today, we're taking a truly in-depth look into Urban Outfitters, Inc.'s second quarter fiscal 2026 earnings. These were released after market close on August 27th.
Yep, URBN.
And you look at these numbers, I mean, on the surface, they're absolutely fantastic. We're talking record revenues, soaring profit.
Really strong, yeah.
Yet, the market reacted quite cautiously. Shares actually declined about 5% after the call. And to me, that's the real mystery we need to, unravel today. What did the market see that might not be immediately obvious in these, otherwise stellar results?
It's a fascinating paradox, isn't it? You've got URBN delivering these record revenues and profits and strength radiating across all their brands.
Which is rare these days.
It really is, especially in this retail climate. However, it does seem the market was looking past these robust Q2 numbers.
Right, focusing on what's next.
Exactly. Focusing instead on forward guidance, particularly around new tariffs, and maybe also just the huge run-up the stock has had over the past year.
Good point. It's rallied a lot.
So it's a classic case, really. Strong operational execution meeting, a skeptical forward-looking market. We should definitely unpack what those signals were.
Okay, let's dive straight into the numbers then. Q2 FY26 delivered some serious highlights. The company reported GAAP EPS of $1.58. That's generally accepted accounting principles earnings per share.
Yeah, and that number significantly surpassed analyst consensus.
Beating expectations by a healthy margin. And revenue itself hit a record, $1.5 billion?
$1.5 billion, an impressive 11% increase year over year.
Also beating predictions there, too.
Yeah.
What's really striking, I think, is the profitability. Gross profit surged 15% to $566 million.
And look at the margin expansion.
Yeah, gross margin expanded a healthy 113 basis points. It's just over 1%, bringing it to 37.6%.
Which is pretty strong for retail.
And here's a testament to their diversified portfolio, like you said. Every single retail segment brand delivered positive comparable sales.
All of them, including Urban Outfitters itself.
We'll get to that.
Yeah.
And Nuuly, their rental service revenue exploded over 53% year over year. Active subscribers up 48%.
Just huge growth there.
Even a wholesale segment saw an 18% revenue increase. I mean, these numbers, they paint a picture of just undeniable momentum.
Absolutely. These are, without a doubt, exceptionally strong operational figures, especially that broad-based growth.
Right.
Management really emphasized that, all 5 brands reporting positive comps, including that notable turnaround for the Urban Outfitters brand itself. Well, it isn't just luck.
It speaks to something fundamental.
Exactly. It speaks to fundamental strengths. However, as you alluded to, while the company was celebrating these wins, the investment community seemed to be weighing these against potential headwinds looming on the horizon.
So with those strong top-line numbers, I'm especially curious about what drove that impressive gross margin improvement this quarter. That was a real standout.
Yeah, it really was. And what's truly fascinating here is the underlying discipline.
Discipline, how so?
Well, the significant gross margin improvement, it was primarily driven by lower markdowns across the board, particularly at the Urban Outfitters brand.
Fewer sales. Selling more at full price.
Exactly. It isn't just about selling smarter. It reflects, I think, a strategic mastery of their supply chain and trend forecasting.
Which is tough in fashion.
Notoriously. In an industry prone to markdowns, especially with rapidly changing fashion cycles, URBN's ability to consistently sell at full price suggests a fundamental operational edge. Almost like a luxury brand's pricing power, but, at a mass market scale.
Interesting comparison. And you mentioned occupancy leverage, too.
Right. And that occupancy leverage, it just means their fixed costs, things like rent and utilities, became a smaller percentage of their surging revenue. So each sale became even more profitable.
That makes perfect sense. Okay, let's shift our focus to the individual brand performances, because that diversification is clearly a major part of this story. Anthropologie, for instance, continued its remarkable run.
Indeed. Anthropologie is on an incredible streak. It's marking its 4th consecutive year of quarterly positive comparable sales.
4 years straight. Wow.
This sustained performance truly underscores its ability to, expand its lifestyle offerings and deeply connect with a multi-generational customer base.
And what's driving that?
It was fueled by strong growth across all product categories and successful new own brand launches. They mentioned Celandine, Daily Practice, and their new intimates and lounge brand, Lyrebird.
Lyrebird.
And the Mave label expansion, they're piloting a standalone store in Raleigh, North Carolina that looks like a shrewd strategic play for continued relevance and capturing a larger market share.
Anthropologie's 4-year streak is undeniably impressive. But, every hot streak eventually cools. Are there any signals, maybe subtle ones, that might suggest saturation or emerging competitive threats? Or are they truly just firing on all cylinders?
That's a crucial question. For now, the data points suggest they are indeed firing on all cylinders. They're continuing to innovate with new brands, expanding their physical footprint, like with that Mave store.
And the diverse product mix helps?
It does. Their diverse product categories, from apparel to home goods, insulate them somewhat. I'd say the biggest threat would likely come from a broader economic downturn impacting discretionary spending.
Makes sense.
But within their niche, they show remarkable resilience.
Okay. Then you had Free People and FP Movement also delivering impressively.
Yes, Free People saw a 14% increase in total revenue, double-digit operating income growth.
Pretty solid.
And FP Movement, their activewear brand, that really led the charge. Robust 30% total growth.
30%.
Yeah, which included a 14% retail segment comp increase and a whopping 52% wholesale sales growth.
Wholesale grew 52%.
Wow. This just highlights the immense strength and strategic importance of their activewear and wellness segments. FP Movement in particular is clearly resonating deeply with consumers. It's building a highly loyal, or as we sometimes call it, a sticky customer base that keeps coming back.
That activewear trend is powerful.
It really is. It's a segment with powerful tailwinds that URBN is capitalizing on expertly.
Then there's the Urban Outfitters brand itself. It's certainly faced its share of challenges over the past few years, but it seems like it's finding its footing again.
It truly is. The Urban Outfitters brand reported its second consecutive quarter of positive comparable growth globally.
Second quarter. Okay, that's a trend.
Exactly. Europe actually led the way with double-digit comparable sales, and North America also achieved positive growth, notably driven by a very strong July performance.
What turned it around?
Well, this return to growth seems to be a testament to management's renewed focus on core categories like denim and loungewear, plus that disciplined inventory management we talked about, and some new targeted marketing strategies.
So, profitability for the UO brand this year.
Management said profitability isn't expected this fiscal year for the Urban Outfitters brand as a whole.
Okay, still a ways to go there.
But the trajectory is clearly positive. It's heading in the right direction, shaking off those past challenges.
And then, Nuuly, you called it the structural growth engine earlier. These numbers are truly eye-popping.
They really are.
What does this massive growth and rapid expansion, especially into untapped markets, what does that signify for its long-term competitive position?
Well, Nuuly's success is phenomenal. It achieved its most profitable quarter ever, boasting a 9% operating profit rate.
Profitable rental. That's impressive.
Very. Its revenue was up over 53%. Active subscribers increased by nearly 50% year over year, adding an impressive 120,000 average active subscribers.
120,000.
And what's really interesting, speaking to your point about untapped markets, is that 66% of new subscribers had never rented clothing before.
2/3 were new to rental entirely.
Exactly. When I first heard about clothing rental, I admit I was a bit skeptical myself.
Me too, honestly.
But Nuuly's numbers truly show how a well-executed service can shift consumer habits. It's almost like, Netflix for your wardrobe, but for higher-end fashion. It's bringing a whole new demographic into the circular economy.
That's a huge potential market then. So with this kind of success, what are the implications for the company's investment strategy? They must be pouring money into it.
They are. Nuuly's success is driving significant investments. They're expanding their Kansas City logistics operations from, I think, 600,000 square feet to 1 million square feet.
Wow, nearly doubling it.
It demonstrates management's conviction in its future, and it raises that important question: how much further can this recurring revenue model scale? And what kind of unique competitive advantages does it continue to build for the company in the apparel market?
Right, because those strong unit economics, meaning each subscriber is profitable and the expanding infrastructure, they're creating pretty significant barriers to entry for potential competitors, aren't they?
Absolutely. It's becoming a real moat.
Okay, looking forward then. Q3 guidance. What did management say?
They guided for high single-digit total sales growth, with mid-single-digit comparable sales across all the retail brands, Anthropologie, Free People, and Urban Outfitters.
And Nuuly.
Nuuly, as you'd expect, is poised to continue its impressive mid-double-digit revenue ascent.
But There's always a but.
There is. However, the main headwind they flagged for the second half of the fiscal year is the impact of increased tariffs.
Ah, the tariffs. Which ones?
Specifically, there's a new 50% tariff on goods from India, and that's estimated to pressure gross margins by approximately 75 basis points.
75 basis points.
All right.
So just to put that in perspective, if their gross margin was, say, 37.6%, this would effectively reduce it by 0.75%.
That's right. It's a significant factor to watch and clearly a point of anxiety for the market.
Okay. And how is the company planning to tackle these tariff pressures? Did they outline a strategy?
They did. They outlined a four-pronged mitigation strategy. Seems quite proactive.
What are the prongs?
First, negotiating better terms with vendors. Second, diversifying sourcing countries, trying to reduce reliance on any single region, especially India now.
Makes sense.
Third, shifting transportation from more expensive air freight to more cost-effective ocean freight where possible.
Standard playbook there.
And finally, only as a last resort, they mentioned gently raising prices, but specifically protecting those crucial opening price points to maintain accessibility.
Gently raising prices.
Okay.
Despite these tariff headwinds, management still sounds confident. They're aiming for 100 basis points of gross margin improvement for the full fiscal year 2026.
That's what they said.
That's a bold statement, considering that 75 basis point hit from tariffs.
It absolutely is. This confidence suggests, well, strong operational agility and a robust plan for navigating these external pressures.
So they think the other improvements will outweigh the tariffs.
It implies that their other margin improvement initiatives, like those lower markdowns and the occupancy leverage, are expected to more than offset the tariff impact. This is where their supply chain discipline will truly be tested.
Let's talk about expenses quickly. SG&A selling, general, and administrative costs.
Right. Those are expected to grow roughly in line with sales for the second half.
Which is generally a healthy sign, right?
Yeah.
Costs growing with revenue.
Generally, yes. However, they did flag that Q3 will see some deleveraging.
Meaning expenses grow faster than sales temporarily.
Exactly. Putting some pressure on operating margins in Q3. That's largely due to increased marketing spend for Nuuly and also for Anthropologie's Maeve campaigns.
Investing in growth.
Investing in growth. But they expect to see a rebound in leveraging again in Q4, where those marketing efforts start paying off and SG&A should grow slower than sales, boosting profitability again.
And capital spending.
Capital expenditures are planned at $270 million for the full year, primarily dedicated to retail store expansion, technology, and logistics, including that big Nuuly facility expansion in Kansas City.
Okay, clear priorities there.
Shows where they're allocating resources for future growth, definitely.
Now, let's get back to that curious market reaction. You know, despite all these strong operational results, the bullish management tone, shares still declined about 5% after the call.
Yeah, it's puzzling on the surface.
You mentioned the market is heavily discounting past performance because of the tariff overhang. Do you think that's a fair assessment? Or is there maybe a possibility the market is overreacting to these external pressures, perhaps missing URBN's underlying resilience?
That really is the million-dollar question, isn't it? It appears the market is heavily discounting that strong past performance, especially given URBN's huge 110.8% total return over the last year.
Can't ignore that run-up.
You can't. Analysts seem laser-focused on the tariff overhang as a clear and present headwind. And they're also asking, okay, where does the incremental upside come from now, especially after such a strong rally?
So it's a what have you done for me lately and what will you do next kind of thing.
Precisely. It's a classic late cycle mentality where macro concerns like tariffs often get prioritized over strong micro execution. Now, whether it's an overreaction, well, time will tell. But the market's current lens is definitely focused on future headwinds rather than celebrating past victories.
And on the macro front, what did the CEO say about the consumer?
CEO Richard Shein noted that consumers are feeling very optimistic. He pointed to positive traffic, positive transactions, and positive conversion rates as evidence.
So people are coming in and buying.
Yes, but interestingly, average order value, or AOV, was down slightly.
Oh, why is that?
He attributed it to a mixed shift towards lower price categories like athleisure, lounge, and accessories.
So what does that tell us?
Well, it raises an important question about consumer resilience and discretionary spending. While demand is certainly there and traffic is good, consumers appear to be selective. They're opting for value in certain categories.
So maybe still spending, but cautiously.
That slight dip in AOV could indicate a cautious underlying sentiment, yeah, where people are still shopping, but perhaps trading down a bit or being more thoughtful about larger purchases. It's a subtle signal amidst the overall optimism.
Okay, one other point mentioned was the end of the de minimis exemption. That's the rule allowing low-value imports into the U.S. without duties.
Right, that's the one.
Management seemed to think it was an immaterial impact for URBN itself. They don't use it much.
Right, very small impact for them directly.
But could this potentially benefit them indirectly, maybe by creating a tougher competitive landscape for rivals like, say, Shein?
Absolutely. I think that's a key strategic point. While the direct impact on URBN is minimal, the indirect benefit against ultra-fast fashion competitors like Shein could actually be significant. Well, those companies heavily rely on the de minimis rule to ship tons of low-cost items directly from overseas to consumers, avoiding tariffs and duties.
Right.
If that exemption goes away or gets tightened, it really levels the playing field somewhat. It forces those competitors to either absorb higher costs, raise prices, or completely rethink their supply chains.
Which could make URBN's mostly domestic operations look more competitive by comparison.
Exactly. It's a subtle shift, but potentially impactful on the competitive landscape.
Okay. So as we head into the second half in fiscal year 2026, what are the key areas investors will be watching really closely for this, well, multi-engine company?
Investors will be zeroed in on several key areas. Q3 comparable sales, obviously, that's always critical.
Got to see if the momentum continues.
Definitely. Then Nuuly's subscriber growth and its unit economics, seeing if that scaling continues profitably, is huge.
Right. Prove the model keeps working at scale.
Critically, the actual gross margin trajectory under that tariff pressure will be scrutinized. Did their mitigation work? How much did it really hurt?
See if they hit that full-year target despite the headwind.
Precisely. And of course, the quality of holiday merchandising. It's always make or break time.
Always.
So yeah, it's a story of a resilient multi-engine company facing some significant external pressures and, frankly, high market expectations. Execution on these specific points will be paramount.
Okay, great summary. As always, our final segment is This is Not Financial Advice. We're putting on our imaginary hedge fund analyst hats
Got mine on.
to pitch an outrageous but plausible trade idea based purely on the information we've just discussed. What have you got?
All right, here's my pitch. I'm proposing a long-short pair trade. We go long Nuuly and short Urban Outfitters men's apparel business.
Okay, interesting pair. Long Nuuly, why?
On the long Nuuly side, look, it's a proven, high-growth, record-profitable business. It has strong retention, rapidly expanding logistics infrastructure.
The numbers speak for themselves there.
They really do. It's adding 120,000 average active subs year over year. And crucially, that 66% number, new subscribers who'd never rented before that, indicates a massive untapped market.
Huge potential still.
And management's confidence, shown by those further investments, the big facility expansion, it suggests a future as a potential standalone market-leading entity.
A spin-off candidate.
That's my thesis. Nuuly, with its predictable recurring revenue and strong unit economics, looks like a prime candidate for a future spinoff. That could unlock significant shareholder value way beyond URBN's current retail valuation. So we buy into that future potential.
Okay, I see the long case. A bet on unlocking Nuuly's value. And on the short side, you're targeting a very specific part of the Urban Outfitters brand, the men's apparel business. Why specifically men's?
Right. Conversely, we short Urban Outfitters' men's apparel business because while the Urban Outfitters brand as a whole is showing a turnaround,
Which we discussed.
management explicitly stated that a return to profitability for the brand as a whole is not expected this year. And specifically, they called out the men's apparel business as still rebuilding under new leadership. They said a noticeable difference expected by spring at the earliest.
So a longer road for menswear.
Exactly. It indicates a longer, more uncertain path to recovery for this specific segment. It'll likely continue to be a drag on the overall UO brand profitability in the near to midterm.
So you leverage that drag against Nuuly's strength.
Precisely. It's a targeted bet on the company's internal divergence. You've got a clear winner in Nuuly and a segment in menswear that's still searching for solid footing.
Interesting play. Long the growth engine, short the segment that's lagging. Okay, that's our deep dive into Urban Outfitters Q2 FY26 earnings.
Quite a bit to digest.
Definitely. The key takeaway seems to be a company delivering strong operational performance across a diverse portfolio.
Anthropologie, Free People, Nuuly all doing well, UO turning around.
But navigating a cautious market that's really focused on those tariffs and asking questions about future upside after that significant rally.
Yeah, the ability to effectively mitigate those tariff impacts while continuing to scale growth engines like Nuuly, That's going to be critical for sustained investor confidence.
The market's forward-looking lens is clearly at play here.
Absolutely. Prioritizing future challenges over past successes right now.
Okay. Well, remember, the information presented here on the deep dive is for informational purposes only. It is definitely not financial advice.
Please, always do your own research.
And consult with a financial professional before making any investment decisions. We hope this deep dive provided some valuable insights into URBN's latest quarter for you. What stood out to you from this earnings call? We always love hearing your thoughts and questions.
Yeah, let us know.
Until next time, stay informed and keep digging.